Hey everyone! Today we're diving into the dynamics of the silver market as of December 11th, 2025. Spot silver just hit a new high above $63 an ounce, up over 3% today alone, amid tight supply conditions, booming industrial demand from solar, EVs, and AI, plus escalating trade tensions. We'll break down the key fundamental drivers, review the latest updates from Comex and LBMA, and examine market sentiment. Stick around for the full, balanced analysis on this significant market move. Just a quick mandatory note, this content is for informational and educational purposes only, not financial advice. I'm not recommending buying or selling any assets. Always conduct your own due diligence and consult qualified financial professionals. All right, let's get right into it. The silver market is currently seeing strong momentum, and if you've been following commodities, you know this is supported by some noteworthy fundamentals. As of today, December 11th, 2025, spot silver is trading above $63 per ounce in the intraday session, marking a fresh high. That's a gain of over 3% for the day and about 6% for the week so far. Year-to-date, silver's up a substantial 114%, a performance exceeding both gold and Bitcoin in this cycle. What's fueling this? A projected fifth straight year of global supply deficits, potentially exceeding 200 million ounces, where industrial demand is currently outpacing what's coming out of the ground. First off, let's talk about the supply tightness that's intensifying every day. On the LBMA side, the London Bullion Market Association, their free float inventories are sitting at around 155 million ounces. To put that in perspective, that's barely 6 weeks worth of global demand at current rates. Lease rates have come down a bit to about 11%, but remember, they spiked to 39% back in October, indicating past stress to secure physical metal. Delivery delays for large orders are now stretching into weeks, largely because ETFs have seen significant inflows, up to 35 to 40% year-to-date, and the market is reacting to potential tariffs impacting flows. Over on Comex, the commodity exchange in New York, registered stocks are at 456 million ounces, but we saw a drain of 927,000 ounces just yesterday, December 10th. That's a clear sign of repositioning as people pull physical metal out of the vaults. The paper-to-physical leverage is still high, around 300 to 1, which represents the theoretical difference between futures contracts and the underlying available metal. Now, trade barriers are a key factor adding to this complex environment. China rolled out a new export licensing regime that's set to kick in on January 1st, 2026, which is already creating pressure on global flows. Shanghai premiums are at $1.20 over COMEX prices, which suggests buyers there are willing to pay extra to secure supply. On the U.S. side, the Department of the Interior designated silver as a critical mineral on November 6th, which could potentially lead to 50% tariffs under Section 232. That's widened the spread between London and New York to $1.55, currently limiting arbitrage opportunities where traders could profit from price differences between markets. Demand from industry is another huge piece here, and it's not letting up. The Silver Institute is forecasting fabrication demand for 2025 at over 700 million ounces, up 3% from last year. Photovoltaics, that's solar panels, are consuming more than 20% of the supply, with about 20 tons needed per gigawatt of solar capacity. Electric vehicles are projected to see silver use grow at a stable 3.4% compound annual growth rate through 2031. And don't forget AI data centers, which rely on silver for its high conductivity in electronics. Overall, total demand is hitting 1.12 billion ounces, while mine production is flat at around 813 million ounces. That's a notable supply gap that recycling and above-ground stocks are attempting to bridge. There's broader momentum building too. Just yesterday, December 10th, India's pension funds got the green light to invest in gold and silver ETFs, which could bring in new institutional capital. Meanwhile, the Fed's rate cuts and signals of quantitative easing are generally lifting risk assets across the board. The gold-silver ratio is currently at a historically high level, suggesting silver is still relatively inexpensive compared to gold, which could attract more crossover buying. Shifting to the Comex specifics. The March 2026 silver futures contract closed at $63.95 per ounce today, up 3.39% intraday. Yesterday's close on December 10th was $62.505, with a 2.42% gain and trading volume at 25,846 contracts. Rumors are circulating about a potential 400 million ounce delivery pullback, which is market speculation that has not been confirmed. Inventories are under pressure, but we haven't seen a default yet. Analysts are warning, though, that if physical demands keep ramping up, we could potentially hit limit up scenarios, where prices jump by the maximum allowed in a single session. On the LBMA front, spot volumes are staying elevated and we're in backwardation. That's when spot prices for immediate delivery are higher than futures, reflecting tight near-term physical supply. London's vaults hold about 844 million ounces in total, but roughly 80% of that is locked up in ETFs or under lease agreements, so it's not freely available. The market is dealing with backlogs from efforts to thrift, meaning use less silver in products, and a large demand spike from India in October. No new fixing data came out today, but the spot price is aligning with Comex at around $63, with that $1.55 premium between London and New York. Over on X, traders are certainly expressly bullish. Many are targeting $70 in the short term and even $80 by year-end, driven by those inelastic industrial needs and what some are calling an export Armageddon from the trade restrictions. However, it is crucial to understand the substantial risks. Volatility is high, and a sharp corrective pullback of 25 to 50% is a real possibility if industrial demand projections are revised downward or if trade tensions ease unexpectedly. This is a highly leveraged commodity market, and sudden downturns can happen rapidly. The structural deficits simply point to potential sustained upside pressure, but this is not a guarantee of future performance. That's the latest factual analysis on silver as of December 11, 2025. It's a fascinating market to watch, with so many moving parts from geopolitics to tech demand. Remember, this video is purely educational and based on publicly available data. It is not investment advice, and we do not offer personalized financial recommendations in any way. Markets are inherently volatile, and commodity trading carries significant risk, so please do not make any buying or selling decisions based solely on what you've heard here. You must conduct your own independent due diligence, and if needed, speak to a qualified financial advisor who understands your personal situation.